Bonds issued at a premium. This is when the contract rate of the business's bond is greater than the market rate, which is the rate that other similar bonds are paying. So the contract rate is greater than the market rate, which means that the bond selling price is going to be greater than its face value. This is because if a business is offering a bond that is providing more interest than other similar ones, a rational investor would choose to invest in a bond that has a greater contract rate, so a greater interest rate of return. So since a business knows that, a rational investor is more likely to choose their bond anyway, they can sell it for a higher price because an investor would be willing to pay more for it to get that additional interest revenue. Now we'll look at the journal entries for when a bond is issued at a premium. So you'll notice some similarities with one difference. So in this example, we are going to look at a bond with a face value of $1,000, but it's selling at a premium for greater than that at $1,100. So remember, anytime a bond is issued, you debit cash because the business is increasing their cash. You always debit cash for the actual amount that was received. So the $1,100 that the investor paid to the business to purchase the bond. You also have to record the liability, which is bonds payable. Bonds payable is always recorded at face value, and it stays that way. So bonds payable is the face value of $1,000. The cash that is debited is the actual amount received. And you can see that here because we're debiting cash for $1,100 and we're crediting bonds payable for $1,000. But if we just do those two steps, you can see that our journal entry is out of balance. So we need an additional $100 here, and the account that we will use for that is called premium on bonds payable. Premium on bonds payable is credited when we are initially recording the bond issuance. Not to get you confused, but remember, when we are issuing bonds at a discount, we debit the discount on bonds payable account. That's only when we're issuing. When we're issuing bonds at a premium, we credit the premium on bonds payable account. Again, here's the journal entry. Remember that the debit to cash is for the amount received. Bonds payable is the face value. And then premium on bonds payable will be credited for the difference. So if you can figure out a couple parts of the journal entry, then even if you don't remember whether premium on bonds payable needs to be debited or credited, you can see whether the debit side or the credit side of the journal entry needs that additional amount. So premium on bonds payable has a normal credit balance. That is why we credit it when we are initially recording a bond premium. Book value. Similar to when bonds are sold at a discount and we have to record a book value there to get a net amount of the bonds essentially. We have to do that when bonds are sold at a premium also. That is because bonds payable always is the face value of the bonds until they are mature and that money is paid back to the investors. Bonds payable will always be the face value of the bonds. But that doesn't tell the whole story if the bonds are sold for less than or more than the $1,000. So we have to adjust that to tell more of the whole story. So here, when we're looking at the book value or carrying value of the bonds, you take bonds payable, which is the face amount, and you add the $100 of the premium to get the book value of $1,100. So initially, when you're looking at the book value, right when you record the first issuance, the book value will be the cash received amount. So now looking at the journal entry for the interest payments. So just like with a discount and how we amortize a discount, you have to do the same thing for a premium. So you just take that same logic that we talked about in the discount lecture video, and you apply that to the premium here. The objective is still the same, and that is to take the total amount of the premium and divide it equally between each of the interest payments. So you can see this will be our journal entry when we record the interest payments to the bondholders. The difference between the interest expense, which remember is not just the cash that is paid to the investor, but the interest expense will be adjusted based on that premium amortization. So we'll do an example to make sure that makes sense. Wilkie Company issues 10% 5-year bonds on January 1st. We'll say, well, the year doesn't matter, so that's okay. So on January 1st, with a par value or a face value of $200,000 and semi-annual interest payments. So before we look at the chart below or the table that might seem a little overwhelming at first, let's look at the pieces of information that we are given here in the problem. So the contract rate is 10%. They are 5-year bonds with semi-annual interest payments. So if they're 5-year bonds and there are 2 payments per year, then 5 years times twice a year means that there will be 10 interest payments. They're issued on January 1st with a par or face value of $200,000. So now in looking at the table below, you should recognize it just a little bit because we filled out something similar to this in the discount lecture. So you see that you have 2 columns here, the unamortized premium and the carrying value. Remember in the discount lecture when we were looking at the example, we had a very similar table. The only difference here was that it was unamortized discount instead of unamortized premium. So the same logic applies here, so I'm not going to go through it in as much detail as I did in the previous video. So with this information we have, we need to use the straight line bond amortization table, which is what they provided here, and prepare journal entries for the following: the issuance of bonds on January 1st and the first interest payment on June 30th. We need to set up our journal entry for this. Just as a reminder, these are 10% bonds, 5 years, semi-annual interest payments, which means 10 interest payments. And the face value is $200,000. So we're not going to worry about the table just yet. Let's start our journal entry and then see where we need to adjust it. So when bonds are issued, January 1st, when bonds are issued, you debit cash always, and the cash will be debited for the amount received. So to figure out the amount received here, this is when we look at the table. Remember January 1st, so the issuance date, this shows us the amount of unamortized premium on day 1 and the carrying of value on day 1. This unamortized premium is the amount of the premium at issuance. So we know that we are going to have to record a premium of $16,222. What that means is the cash that was paid is the $2,222. So we'll debit cash for $216,222. We know that we have to credit bonds payable for the face value, which is $200,000. And just by looking at this journal entry, you can tell, because it's out of balance, that there's going to have to be an additional credit of $16,222. That credit will be to the premium on bonds payable account. And I'm going to abbreviate bonds payable. So that's the journal entry at issuance. There are a couple different ways that you could have figured out the numbers that go here based on the table above. But if you look at this very first line, you can see this is the exact information that we needed, because the amount of the premium, the unamortized premium at the issuance date, is the amount that we record on for premium on bonds payable. The carrying value on day one is equal to the cash paid. And then, of course, we know the $200,000 is the face value, and bonds payable is always recorded at the face value of the bond. Now we look at the interest expense journal entry. So we are going to record the June 30th interest payment journal entry. So the basic journal entry is set up as a debit to interest expense, a debit to premium on bonds payable, and a credit to cash. The credit to cash will always be the face amount times the contract rate times the amount of time for each payment. So the face value is $200,000. The contract rate is 10%, and these are paid every 6 months, so 6 out of 12. When we calculate that, that equals $10,000. So the cash paid to bondholders every 6 months will be $10,000. So we know we'll have to credit cash $10,000. Now we have to figure out the amount of the premium that will be amortized every 6 months. So with this table here, I mentioned that something very similar we worked through in the discount problems. So in looking at our unamortized premium starting out, it is $16,222. So this is the total premium that will need to be allocated over the interest payments every 6 months. So we need to find out the total number of payments so we can figure out how much to allocate in each journal entry every 6 months. So if we know the total is $16,222, that's the amount that will need to be amortized equally. So to figure out how many total payments there are, we look at the information that they are 5-year bonds, and they are paid interest semi-annually, so that means twice per year. So 5 years times twice per year equals 10 payments. So the amortization for the premium needs to be equally divided over 10 interest payments. When we do that, we get an amount of $1,650. $1,622. So that is the amount that will be used in our journal entry as the premium amortization. So look at our journal entry. We see that premium on bonds payable will be debited, and that amount is $1,622. To figure out the debit for interest expense, we look at what we're missing here. So our credit is $10,000. Our debit, we can see we need to plug in the number here. To figure that out, we take $10,000, our credit amount, minus 1,622, which we already have on the debit side, and that gives us a total of 8,378 as the interest expense.